This quick video is going to be on trading psychology. Now there's a million and one different things out there on Google, so if you want to go research it to your heart's content, go ahead. There's different types of trading psychology for day trading, swing trading, long-term, short-term, mid-term. There's a whole bunch out there. So I'm just going to cover things related to day trading and the things that are, I guess, quite practical. So when people first start out trading, they learn three things. First, they learn the technical analysis. They learn the trend lines, they learn the MACD, they learn the Fibonacci, the fettuccine. Then they learn the fundamental analysis, the things like who's on the board, what's the market cap, what's the earnings, the general financials. And the third thing they learn is trading psychology. And arguably that comes too little too late for some people. They learn that their trend lines aren't particularly working, they learn that their fundamentals aren't really making a difference, and then they realize that, well, shit, I actually kind of suck at picking my entry and exit points. And even when they do pick the right entry points, they tend to just fail at exiting. So some people can actually be really, really good at their entry points. They can pick perfect bounces. If it's just, something bounces on the 50% Fibonacci and it just rallies, fantastic. They can ride that wave. But when it comes to losing money, that's a whole different ballpark for some people. In fact, for many people when they first start out trading, they really suck at losing money. So what I like to tell people when they first start out trading is that you shouldn't call yourself a day trader. You shouldn't call yourself a trader or an investor at all. You should change your mindset and tell yourself that you're losing money professionally, because that's what you should be doing. You should be controlling your losses far more than you should be focused on making money. This is a key concept people typically don't learn till very later on in their trading career. The reason this is so important is because there's such an emotional attachment to money that people have when it comes to losing. People don't like being wrong, right? There's a certain ego attached to becoming a trader. You want to be successful, you don't want to be wrong. You hope a stock, when it starts falling down, that you hope it's going to go back up because, hey, look, you've got your trend lines, you've got your Fibonacci going, and you go, oh look, it's on the 50%, it'll bounce. Oh no, it's hit the 61. Oh shit, it crashed. Okay, the 78.6. No, okay, and it just drops and collapses. Because realistically, technical analysis doesn't always work. It's an indicator. It's probability. It's not a guarantee. So when people lose money, they typically hold on to it when they first start trading. Even more experienced traders, if they don't have a plan, or rather if they don't follow their plan, they too will lose money. I have no doubt in my mind that there are very profitable traders out there that still fall into the trap of losing more money than they should. However, with more experience, this happens less and less. So how do you actually manage your losses? Well, it's about having a trading plan, and a part of that trading plan is to determine how much you're willing to lose in a single trade. For me, it's anywhere between 8% to 20% in a single day trade. Now that number varies because it depends on the stock, depends on the sector, and it depends on the sort of market cap value of the stock. So if I have a 5 to 10 million market cap stock, I might be willing to trade a $3,000 parcel and willing to risk 20%. So I'm willing to risk $600 on a $3,000 trade. If I'm trading something that's more like 50 to 70 million market cap, I might have an $8,000 to $10,000 trading size, and I'm willing to lose anywhere from 8 to 10% on that. So I'm willing to lose anywhere from $800 to $1,100 in a single trade. And the reason for this parcel sizing for me is because the volatility of a smaller cap stock or a micro cap stock is quite significant. You can see here an example of MTC. It pumped to the upside quite strongly, and of course it dumped just as hard. So the risk to reward is quite healthy for the micro cap stocks if you get in at the right time, but really it is just about setting that stop loss. Because if let's say you miss this stock's run up and you want to catch the bounce, you buy in at this 50% fib level and it drops, you might be looking at this 61.8% level and going, yeah, but it'll probably bounce here. And then of course it doesn't, and you just keep losing. So it's about setting stop losses and actually committing to them. Not just letting them run and not just looking for the next trend line and hoping it bounces, but actually committing to your stop loss. Now for me personally, I've already identified my personality traits. I'm well aware that I can be a bit impulsive on the markets. I know that I can be extremely impatient. So I have a tendency to trade very short term on the Forex and indices. So when I trade the ASX, it is extremely slow compared to these other markets. So I've already identified my weaknesses, and I've already identified how to trade with my weaknesses. So for me, I set a stop loss, and once that stop loss is in place, I never touch it. I used to touch it back in the day. I used to be like, oh, maybe it can bounce. And any time in history that I've ever moved a stop loss, it's never worked to my benefit. So I've learned the hard way so you don't have to. Enter a stop loss, leave it there, and save yourself some capital.